This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Peter Atwater, he's adjunct professor of economics at William & Mary, who before that worked in financial services and with hedge funds. You might recall that he coined, Carol, the term K-shaped recovery.
Yeah, he did indeed. He was recently on to talk about his new book, The Confidence Map, which came out in July. So delighted to have you back. How are you?
I'm doing great. Glad to be here.
Well, it's great to have you here. How are you thinking about kind of the things that are coming at investors right now and just the world at large?
Well, there's a lot coming at investors, but what's been so striking to me about the past couple of weeks is the absence of emotion. We've watched the sell-off in bonds, we've watched the sell-off in stocks, we've watched oil prices rise, and there's this remarkable at ease that investors seem to have, even though markets have gotten oversold, or in the case of oil, overbought. And it's really inconsistent to me with what prices would suggest. So I'm perplexed that people are taking all of this as calmly as they are, particularly because it wasn't, 6 months ago, interest rates were at this level and people were panicking about the banks, and it's a big yawn today.
So what do you attribute that to?
I'm a little worried about real complacent behavior on the part of investors, because there's no sense of that things could get worse. Whether in terms of the economy itself or higher interest rates or inflation, there's almost this sense of, okay, this is what it is. Until the economy gives us signals that it's weakening, or until the consumer rolls over, we're going to count on some sort of miraculous landing of this.
One thing that Carol and I talked about this week was the depletion that we're seeing when it comes to the cash savings of Americans.
Right, household balance sheets.
Household balance sheets. I mean, pretty much everyone except the top 20% has run out of that excess cash savings that they had during the pandemic and post-pandemic.
I worry about those at the low end where the cash ran out a long time ago. I think it's interesting that folks are only taking note of it now, but for those at the bottom, this is a phenomenon that's now more than a year old. And so you're starting to see that roll into delinquency rates, particularly in automobile loans and credit card loans. And the automobile loan one worries me because particularly for low-income individuals, the car is the job.
Yeah.
And they don't have the flexibility of work from home that many above do.
Peter, what do you make of, we were just talking about with Romaine and Katie on our TV side, about the ghost jobs that will never be filled. Are you comfortable with some of the data points that are out there, including the labor statistics here in the United States?
I'm comfortable with the statistics, but what is clear, even with these statistics, is that jobs are not equating to confidence, and that you've seen no material improvement in mood, even though jobs have come back and people are working more. And so I think we do ourselves a disservice to think that having a job is going to boost confidence.
I think it's funny because I think Tim and I talk a lot about like the things that we're paying for in life right now, whether it's homes or rates on buying a home, right?
Insurance is super expensive now.
School, like everything seems super expensive right now.
Yeah, and
we have jobs, and we feel pretty confident about it.
These are the things that are at the low end of the hierarchy of need. So we're not talking about luxury goods where you can do with or without. We're talking about essentials. And so that creates this sense of vulnerability where people feel hostage to either the price scarcity or the supply scarcity or the demand scarcity.
Everything you're talking about, we could have talked about 6 months ago.
Mm-hmm.
We could have talked about in January before the run-up of close to 20% on the S&P 500 this year, which, by the way, has now been pretty much cut in half at this point. So, Peter, what were people ignoring, and what does it portend for the future?
So if I look at the markets over the last 6 months, I think the indices are masking what's really going on, which is this enormous stratification where the low end, Russell small cap stocks are, barely, I don't know this afternoon if they're up for the year.
You talk about this all the time,
We
Terrell.
talk about the small caps underperformance in a big
and
way.
this is an indication of declining confidence and declining success for small businesses. And so I worry that investors, by pouring money into the thoroughbreds, into the Amazon and Apple and Google
Right.
and Microsoft, are being misled by the fact that things are troublesome below the surface. The other, 495 companies.
The other thing I guess I would go to is that when we talk about rates and we constantly keep going, well, highest rate since '07 or the '08 time, and that time really felt like the bottom was going to come out from under us. It doesn't necessarily feel like that time today that bad. But then again, is it because we're not necessarily really reading what's going on? Are we missing things?
Yeah, and I think we're still in this unwind from negative interest rates 2 years ago. And so we tend to look at it on an absolute basis. But it's going to be interesting to see how balanced investors feel when they get their statements at the end of the quarter, where both their stock portfolios
Okay, you're
and
done
bond
now.
portfolios.
No,
Well,
just kidding.
I was going to say a lot of people
Some-
don't wait to get the statements. They, log in when they see red.
I check periodically. But you're right. It's like a reality check of it's again a reminder not everything goes up.
Yeah.
But when we do go, is there something though significant when we do make those references back to 2007, 2008, which was such a significant time in this country, as well as certainly within the financial market universe? Are we setting up for another period that's as rough as some of the stuff we went through there in terms of the markets?
So I think what's been so interesting in the past 2 years is we're seeing a concurrent unwinding of extreme sentiment in both stocks and bonds. The trade isn't risk on versus risk off.
Yeah.
It's risk on versus risk out. And you're seeing that in the growth in money market funds where money is leaving the market outright. And that's a trend we need to keep a lot of attention on, because 07, 08, other than a few weeks, there was this rotation into bonds out of stocks. And that we're not seeing that, even though yields are significantly higher than they were recently.
So where's the money going?
It's going into money market funds.
Over 5% in a money market fund.
Yeah.
You just set it in there until rates,
and
as
you're,
rates
and
keep
you're
going
earning
higher.
more than 10-year yields today.
Yeah.
I mean, so it's a really cash has become a viable alternative. And as I said, with stocks and bonds moving down in price together, that it could start to feed upon itself.
Will it stay that way? Who knows?
Who knows?
Who knows?
But at a certain point, bonds are going to become attractive to some of these people, right?
So that's the question. If bonds were a bubble, if negative interest rates were a sign of extreme sentiment, then we're likely to see that rising rates, falling prices don't draw a crowd. That we've seen everybody who was going to buy a bond did. And much as you see when stock market bubbles unwind, lower price doesn't draw anybody. You get the occasional bounces, but it's a perpetual unwinding machine.
Is it safe to say, we've got about 45 seconds, and you're going to come back and stay with us, and we're going to talk some more, but is it safe to say, and I think you mentioned this earlier, we've never come out of a pandemic. We've never come out of a time period like this. We don't really ultimately know how it all settles.
We don't, but let me create a bull case here. You talk out of both sides of my mouth. I'm an economist.
That's fine.
We've talked about all this cash going into, or all the money going into money markets. That then becomes a potential source for further enthusiasm if sentiment were to bottom.
The cash on the sidelines
The cash on the
grows.
sideline, and there's a lot of it. I mean, there's an enormous amount of cash sitting there, and so you could have this powerful reversal where the crowd says, that was it, that was as bad as it got, and we're back to the races.
I mean, if you're saying that like the S&P 500 at 4,500, you were regretting not putting some money in, now it's at 4,200, and you're like, okay, maybe it's time, or there could be further to go.
Well, and I can create a bull scenario, which is
Quickly.
if the dollar is then going to fall,
Right.
you start to see a declining dollar. That's a huge tailwind for these mega caps.
With us is Bloomberg News congressional reporter Erik Wasson on the phone at the Capitol in Washington, D.C. Still with us, Peter Atwater, adjunct professor of economics at William & Mary and author of The Confidence Map. And Erik, I want to start with you. Give us some color about what are you hearing? What's the environment in and around the Capitol as we count down to that possible shutdown?
Well, I think really the focus is on the House, where even longtime Republican aides and operatives are saying it's just a chaos. They haven't seen anything like it. It's just an inability, really, of the House Republicans to come together on even an offer. They've proposed a stopgap spending bill of between 31 days or 45 days, try to attach that to some border security provisions and make the president come to terms on a border deal. But they can't even really get the votes to pass that. So they're not even off of first base here. And meanwhile, the Senate's moving forward with this bipartisan deal. It's about $6 billion in Ukraine aid, $6 billion for disaster, funds the government for 47 days. Now, if the Senate passes that, which it likely could do by Sunday, government shutdown will already started, but there'll be a lot of pressure on McCarthy to bring that up. But he told his conference he's not going to bring that up today. And so we're really heading to a shutdown.
Erik, you've seen this play out before. So just give us an idea of if the government does shut down, or maybe we say at this point when the government does shut down. Help us by looking into your crystal ball and giving us an idea of when things open up again.
Well, one intriguing possibility is that House moderates conduct a rebellion. We've had a couple of stories on the Bloomberg about that. They have some procedural mechanisms. One's called the discharge petition, where they could, within about 9 legislative days, force a vote against the Speaker's wishes on that Senate bill or on their own rival plan, which would actually extend government funding to January 11th. To be viewed as a betrayal of the party, but they're arguing, a lot of the conservatives have voted against the majority speaker candidate and voted against House rules and other things, so they've also shown disloyalty. So, Mike Lawler of New York, one of the moderate Biden district Republicans, is leading that effort. He can probably bring along 5 other New York Republicans to help him, and that's all it's really needed to trigger this process. So it could be as little as 9 days. There are ways the Speaker could try to thwart that. On the other hand, we could see a resolution quicker. It just really depends on on these moderates and whether the Speaker ultimately decides, just the shutdown's just not worth the pain, not worth risking the House. He could face a motion to oust him. At that point, it'll be up to Democrats whether they bail him out. There's probably enough conservatives that he would be able to be ousted without Democratic help.
The political process. As we said earlier when we began talking with Peter Atwater at the top of the broadcast, Peter, one of the things that's on the minds of investors is this potential for a government shutdown. There is potentially an impact when you don't have government programs, the expenditures going out, you don't have employees being paid, there's an impact. I mean, how do you think about it? I think about William & Mary. They spend a lot of time in terms of policy and the connection of policy and economic impacts.
Yeah, so I often say that policymakers follow mood. And this is policymakers in me, here, now mode. The only thing they care about is their individual survival. And with mood falling, as indicated by the markets, that's going to make getting a resolution together very difficult until there is ultimately capitulation, where some group is led to believe that they're vulnerable in this process. And what we see today is a lot of, between the gerrymandering and the heavy one-statedness that we have in terms of political alignment, that vulnerability is not showing up anywhere anytime soon.
So, Peter, your book is called The Confidence Map, Charting a Path from Chaos to Clarity. Chaos is a word I think a lot of people would associate with what's going on, at least in Washington right now. Erik, you might agree or disagree, I don't know. Do Americans still look for confidence in the government, or have we kind of said, you know what, it's not happening?
The bond market would say they don't. I mean, the markets yawn over what's happening in Washington is remarkable to me. But that is the nature of the investing crowd today.
But is it yawning because they know it's going to get resolved, and it's happened before?
Yeah. I think we're numb to it. But therein lies the danger. Yeah. That belief that ultimately Congress comes to its senses is based on the past and the environment, the mood environment, at least right now, suggests that that may not be the best assumption.
Erik, come on back in here, because it was interesting what Peter said. Like, I do think that there is such a big yawn. I think if I brought this up with a lot of my family members, they'd be like, yeah, okay, tell me something I care about. But I do wonder, Erik, in terms of, do members of Congress, are they getting calls from their constituents? I mean, I'm sure corporate folks might be, if they're not going to get some kind of, government contract payout or something. But I just wonder, do lawmakers hear from the voting members of the U.S.?
Well, some of them say that they aren't hearing, some of them say they are. But I would say we have a couple of really good things on the terminal right now. One is a great story which talks about which lawmakers have the most federal workers in their district. And one of them is Matt Gaetz, who's leading the government shutdown charge. He has the third most number of federal workers in his district. So, these are people who are not necessarily acting in the interests of their constituents. I'd also point out another story I wrote on the terminal, which is about the economic impact. We discovered on we do BGov, Bloomberg government data, that $1.9 billion per day in lost or delayed revenue to federal contractors, and that just is going to grow. You're going to see service contractors laid off and never get back pay. You're going to see production lines disrupted. And who we talked to in that story, basically, they said, this is the time with high inflation, high interest rates. You're going to see a cash flow crunch for some of these small contractors. You're going to see some companies even go belly up in a 6 to 7 week shutdown. So, I think the longer it goes on, the longer the clamor, the bigger the pain, as your guest said, and someone's going to have to capitulate.
Erik, that is such a really good point. I mean, Peter, I do think about that. Smaller companies, man, they live, I feel like, from money in to money out. Like, they just live from day to day in terms of their, financial books, if you will. I mean, that is a possible cost to all of this.
And I think it's yet another moment where those on the left and the right fail to appreciate the vulnerability of those at the bottom in business and individually, and ultimately the potential that those at the bottom say enough of both left and right.
What happens when, or if that happens, Peter?
So I think you start to see grassroots movements where you see pockets of both red and blue individuals and businesses at the low end say, we've had enough.
I feel like you need to Occupy Wall Street or Occupy corporate America, 2.0.
But I mean, maybe that was the Tea Party, or maybe it was the rise of Trump in 2016.
But I think that, and Erik may want to weigh in on this, is that the environment today is uniting.
Well, uniting everybody.
Those with similar vulnerabilities.
Well, Erik, we've got only about 25 seconds. What do you say to that about unifying people?
Well, I think one of the interesting things is how split America is. You've got almost a 50-50 country, and that's why the margin is so small, and that's what's really causing the problem here, is that McCarthy's majority, if he had 20-seat majority, this wouldn't be the issue we're seeing today. The fact is he can only lose 4, and there's a very small number, 5 to 7, who are basically saying, we won't vote for this starting position CR. So I think that's an element of it too, this small House majority.
Right.
And, his personal skills. Nancy Pelosi had a small majority, could get more through. He just isn't able to get those last couple of votes that he needs.
Erik Wasson, we know you're busy. Thank you so much. Congressional reporter at Bloomberg News. Peter Atwater, president of Financial Insyghts, and check out his book, of course, The Confidence Map. Thank you so much.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Steve Case is chairman and CEO at his investment firm Revolution, co-founder, of course, of AOL, which at its peak, nearly half of internet users in the U.S. used AOL. So really just a game changer. And he's back with us on Zoom from Washington, D.C. Steve, it is great to have you back here with Tim and myself on Bloomberg Businessweek. It's been a year since you published Rise of the Rest, How Entrepreneurs in Surprising Places Are Building the New American Dream. It's now out in paperback. How is the entrepreneurial spirit and the American dream doing, in your view, in the pursuit of it?
Well, I think entrepreneurship continues to be alive and well. And the message of the Rise of the Rest book is it just isn't alive and well just in places like Silicon Valley. It's places all around the country. They're developing a strong startup ecosystems. And that's helpful because entrepreneurs who historically would would have to feel like had to leave where they were from to go to the coast to be part of the innovation economy, now can stay and build and scale there and create jobs there. So it's been great to see the momentum over the last decade since we started Rise of the Rest. The pandemic has certainly been an accelerant, almost a tipping point in terms of more people deciding to move other places. So we've seen a dispersion of talent and a dispersion of capital, and a lot of great ideas that are really kind of reimagining healthcare and food and agriculture and financial services and transportation and education. Some of the most important aspects of our lives and some of the biggest industries are really up for grabs in this next phase.
Rise of the Rest is the name of the book. It's the name of the seed fund as well, Steve. What about rise of the rates that we've seen over this year? To what extent is that hurting the startups that you talk to and you interact with?
Well, certainly when rates are higher, there's a little bit of a pullback in terms of the stock market valuations, as we've seen, and therefore a pullback in terms of particularly the late stage private market valuations, the pre-IPO valuations. So we've seen that dynamic over the last 18 months or so, which frankly I think is healthy and not all that unexpected. A couple of years ago, things were getting a little frothy in that later stage. And so we're seeing a correction with the growth stage of the market. On the earlier seed side, it's not quite the same impact, and particularly in these Rise of the Rest cities, the valuations of the seed investments we've done with our Rise of the Rest fund, and so far we've done over 200 investments in 100 different cities. Valuations tend to be about half of what the valuations are for comparable companies at the seed stage in places like Silicon Valley. It's a classic supply and demand. So much capital is focused on venture capital focused on Silicon Valley, not enough on other parts of the country. So that dynamic still creates a great opportunity for investors who are willing to do the extra work to identify promising entrepreneurs tackling big industries in dozens of cities all around the country.
Well, and that's a really good point that you talk about all of the innovation that's going on in other cities beyond Silicon Valley. Having said that, the collapse of Silicon Valley Bank and the fallout, what did you see as a result of that in terms of the work that you're doing and the investments that you're doing? Or none, maybe?
It was a problem. No
Yeah.
question. Even though it's called Silicon Valley Bank or SVB, they actually banked startups all over the country, not just in Silicon Valley. And about half of the startups and about half of the venture firms in America were banked by SVB. So it's been very unhelpful. A number of firms are trying to fill the void and offer different products and services to both the venture funds and to the entrepreneurs, but it's certainly been a negative this year.
Hey, one thing we really wanted to ask you, and was about what's going on in terms of regulation. We've been talking a lot about the FTC suit against Amazon, right? Antitrust case. We've all been kind of waiting for this. And the accusations are that Amazon is monopolizing the online marketplace services by degrading quality for shoppers and overcharging sellers. How do you think about this?
Well, I haven't read the actual case. Obviously, as you said, it's been expected for some time. The FTC has gotten more aggressive on big tech. And
is that
so
good? Is that good that they've gotten
I think
more aggressive?
more scrutiny of big tech, I think, is healthy. My focus is around the new companies, the entrepreneurs, the insurgents that want to take on some of the bigger incumbents, and making sure that there's an environment that allows innovation to flourish, entrepreneurs to be successful, including in areas of e-commerce, or they have a similar case with Google on some issues related to search. So I think that scrutiny is appropriate. Exactly what happens, each court case obviously needs to kind of we'll have to see how it plays out. But I think it is important that we make sure we're erring on the side as a nation of making sure entrepreneurship can flourish everywhere, and big tech doesn't just get bigger, including, by the way, with AI. One of the big debates here in Washington around AI as it gets more attention is it going to end up being a few big companies getting even bigger, or is it going to be a broader, more dispersed innovation ecosystem, a little bit more on the open source side? And so I will see how that plays out over the coming years. But the internet's now so important. Technology is so important. Every industry really is now tech enabled. Every company really is in some ways a tech company. It's not at all surprising that there's more antitrust scrutiny.
Did it ever feel like to you that AOL, in your days of founding and running AOL, was so big that it could have faced more antitrust scrutiny?
No, we actually did, and some of the News Corp and others at one point, filed suit saying AOL had too much control of the internet, and even when we merged with Time Warner, Microsoft, AT&T, others were trying to block the deal with that, that argument. And so, in that particular case, obviously, I hate to say it, but for a whole host of reasons, AOL fell by the wayside. New entrants, including Google and Facebook and others, kind of took over, and it's because those news companies were able to start. They were able to raise the venture capital. They were not not barriers to entry to allow them to start. So that's, to me, the philosophy we need going forward. Celebrate the successes we have in our country, including some of these great companies, Amazon and Google and so many others. But how do we make sure we're also creating an environment so more of those companies can be the big companies of tomorrow, not just on the coast, not just in Silicon Valley, but all over the country, which obviously is why I wrote the book, Rise of the Rest.
So how do we do that, though? I mean, we spoke to Diana Henriquez last week, who, compared the power companies of the 1920s and 1930s and the regulation of the power companies to the tech companies, the huge tech giants today. And she says government needs to get involved with them. What does the government need to do in order to ensure that the rest can rise?
Well, I'm co-chairing the National Advisory Council on Innovation and Entrepreneurship here in Washington. And we're working on a national entrepreneurship strategy, which we'll be releasing later this year. And there's a number of facets to it. Some relate to talent, including immigration policy. Some relate to access to capital, including some of the work around Rise the Rest. Some of it relates to making sure there's continued investment in regional hubs. Congress passed the CHIPS and Science Act a couple of years ago and authorized $10 billion for regional hubs, but it's only so far appropriated $500 million of it. Some of it's making sure America continues to invest in the R&D, the technologies of the future, to create the industries of the future. So there's many facets to it, but the overarching theme, I think, is how do you make sure this next generation of entrepreneurs can start and scale and do it anywhere in the country, not just a few big companies being able to innovate or only people in a few places like Silicon Valley. So it's trying to create a more inclusive innovation economy has to be a key part of the answer.
Steve, we're often so critical of other countries and their supportive industries. I'm thinking about China specifically, but we are increasingly seeing the U.S., whether it's in the semiconductor space, whether it's in the EV or the energy transition, support industries here in the United States. Should we, especially when it comes to some of the more newer, innovative areas?
Yes, and again, there's sort of this long debate about industrial policy, long debate about how much of a role should government play. But the reality is the internet wouldn't exist if the government hadn't funded, DARPA, a research agency, a half a century ago, and then opened it up, commercialized access to the internet, and broken up the phone companies, so the cost of communications, came down. There are a number of decisions that really unleashed the internet. So having that government role, I think, is important. That the innovators need to respect the role of policymakers. And I actually think in the next decade, the two mega themes are going to be place and policy. That we're focused here at Revolution around place, particularly Rise the Rest. We think a lot of the big companies of tomorrow will have a policy aspect to them because of the nature of the industries up for grabs, and because Congress has passed legislation, about $3 trillion of legislation, the CHIPS and Science Act, the Inflation Reduction Act, the bipartisan infrastructure bill, that's going to really invest in these industries in a big way and create opportunities for investors, as well as ensuring that America has the right infrastructure, has the right technologies to continue to be the most innovative entrepreneurial nation in the world.
Got to say, Steve, every time you're on, you just leave us wanting more. So come back soon, and good luck with the paperback version, I should say, of Rise of the Rest.
Thank you, Carol. Thank you.
Okay, be well. How entrepreneurs in surprising places are building the new American dream. Of course, Steve Case.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul Su is with us. He's founder and CEO at Decasonic. It's a firm that invests in and advises around NFTs, cryptocurrencies, blockchain infrastructure, the metaverse, decentralized finance, and more. So it's really kind of on it when it comes to, I feel like, innovation in a big way. In other words, the world of what's become known to many as Web3.
Yeah, Paul joins us on Zoom in Chicago this afternoon. Paul, give us your reaction to Facebook, or I keep calling it Facebook, Carol. Can I still call
stop
it
that? No.
Meta platforms today.
Tim, Carol, thanks for having me again. Very excited to be here and talk about Meta. Certainly, their announcements today points to what early stage VCs are investing in, this intersection of technologies. It's where two or more disruptive technologies converge. In this case, AI and mixed reality, chatbots from Tom Brady with their Quest Pro 3 launch that's upcoming. It's generating a lot of consumer excitement. We see this in history on how Apple also innovated on smartphones, intersecting cellular voice with consumer mobile data.
So, I mean, I keep trying to figure out, like, I get it to some extent, but I do try to figure out, like, how does this really move the needle akin to the internet, which really did move the needle in how we do so much in our world. It's kind of amazing, right? How ubiquitous it is to kind of almost everything we do, whether it's at work, at play, have you. Is that how we need to be thinking about the impact of chatbots and generative AI?
Ubiquity in the internet didn't happen overnight. I think it took about 15, 20 years to really go mainstream. And we're seeing Facebook and Meta also make these long-term investments on an immersive experience. Apple has their Vision Pro launch upcoming as well. It's much more expensive than Meta. And so Meta believes that with the deflation in device costs, this will accelerate mainstream adoption.
You know, one thing that I wonder though, and we were just talking to Steve Case, founder of AOL, who knows a thing or two about starting companies and building them, all about this, because he's got the paperback out of his new book that he wrote last year. Is the environment conducive to startups actually winning in this day and age? I mean, look at this. You have, companies out there that are doing really cool stuff in Web3 and AI and the metaverse, but Facebook is doing its developers conference today and sucking a lot of the air out of the room.
The only data point I could share is we're seeing success in our portfolio companies that are winning. They are taking this approach of the intersection of these technologies. It's not so obvious for a large company to be pursuing blockchain and AI convergence, metaverse and Web3 intersection, metaverse and blockchain intersection, mobile and Web3 intersection. But we are seeing pockets as an early stage investor, that success and trajectory upwards of $100 million in revenues. And that might not move the dial for a multi-trillion-dollar company, but it's certainly very interesting for early stage VCs.
Where are you seeing, or where are you investing the most in? Is it NFTs? Is it crypto, generally speaking, blockchain? Is it the metaverse? Is it decentralized finance? Give us a little bit more specificity in terms of your interest and really the investment interest right now, where you want to commit.
Decasonic is a fund focused on the mainstream adoption of blockchain, Web3, and metaverse. A lot of those use cases are non-financial use cases, and it does bring in global brands with their global communities around digital collectibles. We are seeing a lot of customer heat in this area, a lot of interest, and a lot of revenues starting to scale in these non-financial use cases.
Like what?
For example, in our portfolio company, we have Spaceport. They are working at the intersection of metaverse and blockchain. Spaceport is accelerating deals with creators in blockchain verified royalties. Very timely, as the writer strike focuses on AI and creation. Mobile and Web3 is another intersection. Paragon provides a mobile-first way to experience digital collectibles like the Starbucks Odyssey program. This is very important as Gen Z prefers mobile access to their crypto assets. And lastly, we have an investment in Mawari. They have a tokenized network to deliver mixed reality experiences. This is the intersection of metaverse and Web3. Very important as the VR goggles require high fidelity experiences. So they will work with Disney and Vision Pro and Meta around these goggles.
I got to tell you, this stuff still seems so niche to me. It's not like we're all running around wearing these goggles. And when does it become mainstream?
Today, a lot of goggles are gaming focused. Meta also announced smart sunglasses today, and that might have a higher adoption rate initially. Crypto today is roughly 52 million Americans. A lot of them, 75% of them make less than 100K a year.
Right.
This is data from Coinbase.
I do want to bring up an article that our own Alex Branco wrote earlier today. Snap is set to shutter its business-focused AR unit that was just launched this year. So what Facebook and / Meta Platforms is doing, Snap is saying, okay, we're no longer doing that.
Augmented reality.
Yeah.
I think Snap has a great camera experience, and they've certainly scaled AI chatbots that has influenced Facebook to get into this area.
Well, I'm sorry, Tim, go ahead.
Well, I was just going to say, this is the Ares unit, short for Augmented Reality for Enterprise Services. Yep. It was just announced back in March.
So I wonder too, Paul, the news from Meta today, we just got about 25 seconds left here. Does that somehow make you say, oh, wait, maybe we should be also doing this because of what Meta said today? Just very quickly.
Very quickly, we will assess the news and look at some of the gaming companies that might be optimized for the Quest Pro 3. This was Mark's focus of his demos today, and there will be new gameplay focused on Xbox and Meta integration.
All right. Well, good to check in with you on a day where we've had some news, and you certainly have some overview insight into all of it. Paul, of course, founder and CEO at Decasonic, joining us on Zoom in Chicago. Carol Massar, Tim Stenovec, and this is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, you know what's going to drive you crazy, Tim Stenovec? This market environment.
Yeah, this is enough to drive people crazy.
Poor Tim. Like, we're getting ready for our simulcast with our TV colleagues, and we have to have, decliners and gainers.
And, we're organized. We get this stuff done before the show. We're like, what's down 3%? That's not going to change.
Yes, it is on a day like today.
Thanks, Meta Platform.
We
now
definitely...
it might be down again.
I know we are kind of rolling over again.
Yeah, it's down again.
All right, so let's get to it. Our Drive to the Close guest. Delighted to have back with us Stephanie Pierce. She's CEO of Dreyfus, Mellon and exchange-traded funds at BNY Mellon Investment Management. As we said, back with us, joining us on Zoom in New York City. Stephanie, how are you?
Carol, it's so great to see you. Hello, Tim.
Hi.
Carol. It's
great to have you back with us. It is kind of another wacky trading day, and we, talk about the concerns coming at investors, whether it's the possibility of a government shutdown here in the U.S., the UAW strike going on longer, the worries over this higher rate environment. It feels like investors aren't quite sure what to do. How do you kind of think about what are the important macro trends to pay attention to?
Well, as you know, Carol, we sit here in our short end of the curve world where we talk about lots of really interesting things in that space. From a macro perspective, as you know, we are surrounded by smart people in terms of our economists and our portfolio managers. And we actually think cash is a pretty good place to be right now. We're certainly in this, I would call it, higher for longer environment than people thought a few months ago. There's probably one more hike ahead of us. And at some point here, we want to start positioning and hedging portfolios for lower rates, but we're not quite there yet, right? And so, that's certainly something we're guiding investors to think about. Now is the time to start extending duration. Of course, we in cash land, extending duration means about a year for us, but certainly feeling really good about cash as a very attractive investment, giving other asset classes a run for its money, so to speak.
Well, the thing is, and I was saying this earlier to Peter Atwater, I mean, we've been in an environment where all year cash has looked like a pretty good investment, but you missed out on a run-up of close to 20% in the S&P 500 that's since given back quite a bit of those gains. How do you know when the right time is to get back in, even if cash continues to be attractive?
No, it's a very, very good point. One of the things that we advise when we think about clients that we work with across our ecosystem at BNY Mellon, we have a wealth management business, we have Pershing, we have our very large investment management business. So from a fiduciary perspective, timing the market is always a challenge, right? We all know the statistics about how well that works out. So generally, we advise clients to stay with a strategic allocation, and that allocation in many cases includes cash. So that's the way we think about it.
And you're launching some new funds. Tell us about that.
Well, I have to say, today is a sparkly day for me. Yesterday, we launched the Dreyfus Spark shares, which are a new share class of our largest flagship government cash fund. And even though, we talk about cash as being not that exciting, we think, as Carol, we've talked about it before, cash is not only interesting and I'll use the word sexy from a yield perspective, but what we're doing with this fund and this share class, we're really excited about. So the Spark shares enable our institutional clients to basically give back, do well and do good. So they get the same yield as they get on the full fund, same liquidity, all of that. But we are actually taking 10% of the net revenues on this new share class that we earn as a company and contributing that to the charity of the client's choice. So we get to sit on the same side of the table with clients and help them think about how they can make their cash work harder by putting that money in a place that really matters to the hearts and the minds of their employees, their board, or their stakeholders. So we're really excited.
That is so interesting. Why do that? And why do that now? I mean, forgive me, good thing, no doubt about it. I love to see things like that. But you know what I'm asking. Why do that and why do that now? Has there been demand? Like why?
Yeah, absolutely. So Carol, about a year and a half ago, as you may recall, we launched a share class that we called Bold, also a dedicated share class off our largest fund. And that stood for Block Opportunity for Learning and Development. That share class now stands at about 14 billion or so, having launched it with 500 million. And so what we found through that is a share class that really is dedicated to helping fund students in need at Howard University by, basically filling that gap when they run out of money junior year and have to drop out. And it's been very successful. Our clients have loved it, but many of them said to us, there's something in my community, there's a place where my employees volunteer, there's something we give to as a company that's near and dear to my heart and my backyard that I would love to give to. So if there's a way for you to facilitate that, please call me. So we spent a few months, couple quarters thinking about it. And that's exactly what we're doing. We launched with $1 billion 2 days ago. We're really excited. And or yesterday, sorry. And clients have been really interested. So really what we're doing is allowing them to what we call spark change or enable change in their own communities.
Is there any sort of tax benefit to you guys for doing something like this?
We're really not doing it for the tax benefit. But when clients ask us, gee, do I get the tax benefit? Of course, we are making the donation. So that would not accrue to the investor. It would accrue, I suppose to us in some way. But that's not really the goal of it, right? The goal is to really make an impact. And that's exactly what we're doing.
Hey, listen, Stephanie, what can you tell us, though, about just overall trend flows, like where the money is flowing in, where the money is flowing out right now?
Absolutely. So if you look at the space we've been talking about in cash, we have clearly seen, as I said, many investors, both retail and institutional, looking at this as actually an attractive place to put money, just simply given the 5+% yields. Of course, we are seeing, as you referenced earlier, people be much more comfortable as we think about the economy potentially heading for a soft landing rather than maybe a more concerning one, as we talked about a few months ago. And as that rhetoric has improved from the Fed and in the market as a whole with the data that we've seen, certainly investors are starting to extend out not only in terms of duration in fixed income or money markets, but also in overall portfolios from a risk perspective. So we are seeing some re-risking in the overall environment from investors right now, in addition to this continued attractiveness of cash.
Wait, re-risking, so taking risk off or adding risk on?
No, I think feeling more comfortable that the market is starting to, behave in a manner that recognizes we're probably heading for a little bit of a softer landing than what was expected previously. So that's really what we're seeing is investors being a little more comfortable with the markets here.
What does the rest of the year look like? Help us, get some clarity here. We're very confused here.
We are.
Sure. Let me pull out my tarot cards. So for the rest of the year, clearly, as we've seen, the Fed, was on pause this month. No surprise. We continue to see firmer data. So we do expect that this sort of market pricing in about 50-50 chance of another rate hike is probably going to happen. And that's, continue to see the rhetoric that's the case. And then as you kind of round the corner into the end of the year, the expectation is that, markets will start to position, certainly in our markets, we're starting to position for, hedging against lower rates at some point in the middle part of next year. But again, generally, we don't think that will be an aggressive path downward, as was previously, expected or hoped for. We think it'll be more moderate and, again, higher for longer. So against that backdrop, again, soft landing is certainly where I think the rhetoric has gone. And that's really what we're positioning for as well in our portfolios.
Are you buying the rhetoric? Just 10 seconds. Yes?
Generally, yes. Again, we look at what markets are pricing in.
Okay.
Our goal is to be, let you go. Thanks.
Okay. Listen, always fun and always delighted to see you. Stephanie Pierce of Dreyfus, Mellon and ETF funds at BNY Mellon.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.